Hello guys, welcome to part 2 of stock market terminology. Today's video we're going to cover what does market cap mean, what's PA ratio, what's a P over B ratio, what's the EPS, what's dividend yield, and what's the EBITDA, EBITDA. Tesla as well entering a new type of business, and SEC rejects the Bitcoin ETF. Don't forget to smash the like button, turn on the alarm bell, and don't forget to hit the subscribe button. So today we're going to talk mainly about the key statistics of a company. What's a market cap? Shortly stands for market capitalization. It's basically an indicator that measures the value of a particular asset, company, crypto, stock, commodity, whatsoever, such as Tesla, which just hit $1 trillion. What basically is that a market cap is equal to the price of the share times the outstanding shares available. So let's say, for example, a company's share price is $10 and they have currently 1 million outstanding shares. That makes a market cap of $1 billion. What's the EPS? Earnings per share. As it mentions, basically all the earnings the company made divided by the outstanding shares. So all the earnings are divided by the shares to see how much each share has earned. Say for example a company made $5 and they have 10 outstanding shares. If you divide the $5 by $10, that will make about 0.5 cents per share, which is basically the EPS. It measures the profitability of this company. So in general, if you see this EPS positive, that means that company is profitable. If you see that EPS is negative, that means that company is doing losses. There's either one, the earnings are too less, or the shares, outstanding shares are too many. Let's think it in a basically mathematical way. The numerator, which is on top, and the denominator, which is on the bottom. The higher the numerator is compared to the denominator, basically the higher the top is, the more the better news it is. The lower the number on the bottom is, the better news it is as well. So basically, a positive EPS and a high number EPS is really good. Which gets us to the next abbreviation, which is the PE ratio, or PER, or price over earnings ratio. The price of the stock divided by the EPS, what we just talked about. It gives you an evaluation of how much you're paying for this company. If an EPS of a company is 5, that means you're paying 5 times more than the actual price of this company. So the higher the number of this PE ratio is, the worse this company is, because that means it's overvalued. You're paying more than it is. Such as an example for Tesla, when it was at an evaluation of 1,000. Lower PA ratio is always better. A higher PA ratio is always worse. What this could indicate as well is, say if it's a startup company, they didn't make any earnings and the price could be high compared to the earnings. So you could result in a high PE ratio sometimes. And then what you should look at sometimes is as well the forward PE ratio, which they predict in the future how much the PE ratio should be or will be. So always look for a lower forward PE ratio. What is the dividend yield? Dividend yield is basically the yield or the percentage a company pays to you per year of this stock price. So let's say stock price is $10 currently, or let's say the stock price is $100, and if the dividend yield is 3.5, they basically pay you each year $3.5. Tesla wins approval of Texas state to sell power to people now. They just entered a whole new market. So basically, they're selling now electricity. They've become more of an energy company. What is a P over S ratio, or price over sales ratio? Price over sales ratio basically is the market capitalization over the annual sales of the last 12 months. This indicator indicates the value of investing. You invest basically in this company per dollar. Each dollar, how much you're paying for each dollar. So basically, the lower the number is, the better. The higher, the worse. So if the number is high, basically, that could mean the market cap is too high, or they're not making enough sales. One as well important indicator for the growth investors is the PEG ratio, which stands to price over earnings to growth ratio. What does that mean? That means basically price over earnings ratio divided by the EPS annuals growth. The EP ratio, like we calculated before, is the price of the stock over the earnings. What is an annual EPS growth? The way to calculate it is basically take the EPS of the previous year. So say, for example, we had a company that just last year they released an EPS of $1 per share. Earnings per share is $1 for last year. And then for next year coming, they had an earnings of the EPS turned to $2. So we calculate the earnings per growth ratio is minus the $1 from the coming year, which would result you with $1, divided by the previous one, which is 1. 1 divided by 1 is 1 times 100. So that would result with 100% of earnings per growth. This indicator indicates basically what's the growth potential of this company. EBITDA. Earnings before interests, taxes, depreciation, and amortization. This is basically the earnings of a company before they pay any taxes, interests, or any kind of depreciation whatsoever. It only shows if this business makes money or not. Okay guys, let me know what you think in the comments, and if you have anything you want to ask me, leave a comment below. Thank you guys for watching, really appreciate it. Hit the like button, subscribe button to stay tuned for next coming videos, and turn on the alarm bell. Stay tuned.